Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Blue Owl Capital Inc. Annual Report. Blue Owl Capital Inc. provides a wide range of businesses and services to various clients. The company's offerings can be broadly categorized into several key areas. Firstly, the company offers permanent capital-based solutions that cater to middle-market companies, large alternative asset managers, and corporate real estate owners and tenants. This includes private financing solutions such as direct lending products, alternative credit, investment-grade credit, liquid credit, and other credit solutions. In addition to these services, Blue Owl Capital Inc. also provides GP strategic capital products, which offer capital solutions including GP minority stakes, GP debt financing, and professional sports minority stakes. Furthermore, the company offers real estate products that focus on acquiring triple net lease real estate by investment-grade or creditworthy tenants, as well as real estate debt finance through net lease and real estate credit. The company's services are offered through permanent capital vehicles and long-dated private funds, providing clients with a range of options to suit their needs. Overall, Blue Owl Capital Inc.'s diverse range of businesses and services make it a comprehensive alternative asset manager in the United States. The significant drop in Blue Owl Capital Inc.'s stock price can be attributed to several key events and market pressures that have unfolded over the past year. One major contributor was the proposed merger between Blue Owl Capital Corporation, OBDC, and Blue Owl Capital Corporation II, OBDC II, which faced considerable investor opposition due to concerns about its potential implications, including blocking redemptions and a possible 20% reduction in investment value for OBDC II shareholders. The news of the merger's potential consequences led to multiple drops in Blue Owl's share price in November 2025. Another significant factor was the halt of redemptions in one of Blue Owl's retail-focused private credit funds, Blue Owl Capital Corp. II, OBDC II, announced in February 2026. This move caused a notable drop in the stock price, with some analysts viewing the market's reaction as an overreaction. The broader pressure on the private credit industry has also contributed to Blue Owl Capital's decline. The firm's significant exposure to this market has faced increased scrutiny and warnings from regulators, leading to concerns about credit quality and its exposure to the software sector. Additionally, Blue Owl's financial results for the third quarter of 2025 showed fee-related earnings that missed consensus estimates and a 33% year-over-year decline in performance revenue. This led to a drop in share price on October 30, 2025. Concerns also arose regarding a potential dividend cut due to a high payout ratio and a dip in net investment income, NII. Lastly, the company's decision to divest $1.4 billion in assets from 3 of its credit funds in February 2026 aimed to return capital to investors, reduce debt, and permanently halt redemptions in one of the funds. However, this move may have also contributed to investor apprehension about future payouts and potential sell-offs. Overall, these events and market pressures have cumulatively led to a significant drop in Blue Owl Capital Inc.'s stock price over the past year. Blue Owl Capital Inc. market capitalization of $18 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Blue Owl Capital Inc. holds a significant advantage in their industry. Blue Owl Capital Inc. trades at a higher price-to-earnings ratio of 145 times and a higher price-to-book ratio of 3.35 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company maintains a moderate leverage profile, with liabilities making up 47% of total assets, suggesting a balanced approach between risk management and capital efficiency. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 7.77%. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. Net income and profit margins. A shift in trends. The net income of the company experienced a significant decline between 2024 and 2025. On page 72, it is reported that net income decreased by $30,751 or minus 27.9%, from $109,584 to $78,833. This trend continued on page 93, where net income dropped from $109.6 million to $78.8 million. The profit margins also underwent a change during this period. On page 72, it is noted that profit margins decreased by minus 15.9%, from $1,129,248 to $1,309,072. However, on page 93, an increase in profit margins is reported, from $1.13 billion to $1.31 billion. The reasons behind these changes are multifaceted. Increased leverage and decreased asset value contributed to the decline in net income. Additionally, potential additional reporting and disclosure obligations may have also played a role. On the other hand, increased administrative costs, higher litigation and regulatory enforcement risks, and more complex administration and accounting operations led to decreases in profit margins. The discrepancy between these two trends can be attributed to various factors. While net income decreased due to increased expenses and reduced income, profit margins increased due to revenue growth outpacing expense growth. However, the latter trend was short-lived, as administrative costs continued to rise, offsetting any potential gains. The company's financial performance is a notable aspect of its overall health. One key indicator of this is the generation of positive operating cash flow. This means that the company is able to generate more cash from its core operations than it spends on various activities. According to the provided data, the company's operating cash flow for 2025 stands at $1,547,525. This figure demonstrates a significant amount of cash being generated from the company's day-to-day operations. Furthermore, the net cash provided by operating activities in 2025 is $1,256,032, which also indicates a substantial inflow of cash. The confirmation that the company has positive operating cash flow further reinforces its financial stability. This is indeed a positive sign for the company, as it suggests that it is able to manage its finances effectively and generate sufficient cash from its core operations. The company's debt level and interest expenses have undergone significant changes over the past year. Initially, the debt level increased due to the issuance of senior notes and borrowing under the revolving credit facility. This led to an increase in interest expenses, which were further exacerbated by variable interest rates based on SOFR obligations. As a result, interest expense saw a substantial increase from 2024 to 2025, with figures rising by $41,861, $226,062, and another $41,861 across different pages. Furthermore, the fair value of debt obligations as of December 31, 2025, stood at $3.2 billion, marking an increase from $2.5 billion in 2024. However, there was a notable decrease in the revolving credit facility by $75 million between December 31, 2025, and February 19, 2026. Despite this reduction, the overall debt level continued to rise, indicating that the company's financial obligations remain significant. The recent market analysis has revealed some promising trends. The global market and the United States and Canada have been standout performers, showcasing significant growth and success. These regions have demonstrated a strong demand for products and services, indicating a healthy market environment. On the other hand, there are opportunities for expansion in international markets and the domestic retail channel. While these segments may require additional investment and strategic planning, they hold potential for future growth and development. By focusing on these areas, businesses can capitalize on emerging trends and increase their market share. Management's outlook on Blue Owl Capital Inc.'s strategy is one of continued growth and expansion. The company plans to invest in products and make strategic acquisitions to accelerate growth and broaden its product offerings. This approach aims to generate attractive and income-driven returns for fund investors through GP Strategic Capital. In terms of performance metrics, the company has reported a total net return of 8.6% in one of its products, which management considers a useful measure of overall investment performance. Distributable earnings have also increased by $179,824 from 2024 to 2025. Financially, Blue Owl Capital Inc.'s valuations may fluctuate significantly due to market conditions, but management expects to take substantial goodwill and intangible deductions over a 15-year period. The company is confident in its ability to generate taxable income sufficient to realize deferred tax assets. However, the company acknowledges that it is exposed to market risk through the indirect impact of investment fair value movements on management fees, as well as interest rate risk from investments held in its products. Management will continue to monitor and manage these risks to ensure the company's financial stability. Overall, Blue Owl Capital Inc.'s strategy focuses on growth, expansion, and generating attractive returns for investors. While there are potential risks, management is confident in its ability to navigate these challenges and maintain the company's financial health. The company has made several strategic acquisitions to expand its portfolio and capabilities. Notably, these include the IPI acquisition, Second Oak Street earnout, KAM acquisition, Atalaya acquisition, Prima acquisition, and Dial acquisition. These deals demonstrate the company's commitment to growth through targeted investments. In terms of divestitures, there are no explicit mentions in the provided text. However, a contingent consideration related to the Dial acquisition is mentioned, suggesting that some level of asset disposal or restructuring may be involved. The company's financial history reveals a consistent practice of rewarding its shareholders through dividend payments. As per the extracted summaries, there are multiple instances where it is mentioned that the company has paid dividends, indicating a long-standing commitment to shareholder returns. In addition to paying dividends, the company has also engaged in share buybacks, further demonstrating its focus on maximizing value for its investors. This strategic decision to repurchase shares not only boosts investor confidence, but also helps maintain a stable stock price. Concerns about inventory buildup and supply chain disruption are evident throughout certain sections of the document. On page 24, supply chain disruptions are explicitly listed as a risk factor, indicating potential vulnerabilities in the company's operations. This concern is further emphasized on page 32, where energy and supply shortages, along with supply chain disruptions, are mentioned. These concerns suggest that the company may be at risk for inventory buildup or supply chain disruption due to external factors such as energy and supply shortages. However, it appears that the company has not explicitly addressed these issues in other sections of the document, which could indicate a lack of proactive measures to mitigate these risks. That concludes the financial summary for Blue Owl Capital Inc. Feel free to comment below, and I will be happy to answer them when possible.